Look, most financial experts give you the exact same boring advice. They tell you to dump all your cash into standard index funds, sit back, and wait 30 years for your portfolio to grow. But here is the real problem nobody wants to talk about. Your money is completely locked up. If your index fund pays a tiny 1 or 2% dividend, you can't actually use that money to pay your rent or buy groceries today. To get real cash out of that setup, you have to sell your shares. And if the market crashes, selling your shares means you are locking in permanent losses and destroying your future wealth compounding machine. That is why smart investors are moving away from traditional setups and using what we call the alternative monthly law. We are talking about setting up a legal passive income machine that sends a cash paycheck straight to your account every single month on autopilot. You don't have to wait 30 years, and you don't have to touch your core shares. By law, these specific alternative assets are required to pay out 90% of their profits back to you. Instead of oversaturated broad market funds, we are extracting cash from real-world business rents and secured corporate credit. Let's break down the exact 3 alternative engines that can unlock a $1,000 monthly paycheck without using a single standard index fund. Let's look under the hood of these 3 specific alternatives. The first engine is a premier real estate investment trust, or a REIT. Think of this fund as your ultimate commercial landlord. It owns thousands of properties like grocery stores, industrial warehouses, and retail spaces. They use a special contract called a triple net lease. This means the tenant pays for all the property taxes, insurance, and maintenance. The fund just collects the rent check and passes it directly to you every month. With built-in rent increases, your income automatically scales up over time to fight inflation. The second engine moves into corporate credit through a business development company, or a BDC. This engine functions like a private loan network for middle-market companies. These are solid businesses that are too big for regular banks but too small for public bonds. The best part, these loans are written on floating interest rates. That means when interest rates stay higher for longer, the interest payments on these loans go up, and your monthly dividend payout expands automatically. It acts as a perfect shield for your capital. The third engine is our high-velocity cash booster. This is a single-stock covered call option fund. It targets massive technology companies that experience heavy daily price swings. The fund managers buy the actual tech stocks and write weekly options contracts against them to harvest time decay value. This converts stock market volatility into massive cash premiums, delivering annualized yields between 30 and 55%. When you snap these 3 mechanisms together, you build a synchronized cash pipeline that clears into your balance sheet every 30 days. Now, let's talk about the exact math you need to make this work. If you tried to build a $1,000 monthly paycheck using standard funds like VO or SCHD, you would need to invest nearly $500,000 because their starting yields are so low. But by using this alternative mix, we can compress that timeline completely. We can hit the exact same target with a tight $88,000 deployment. We do this by setting up a strict 50-30-20 allocation layout. You put $44,000 into your net lease real estate engine, $26,400 into your secured corporate credit engine, and $17,600 into your high-yield options booster. The blended annual yield of this entire setup comes out to around 13.65%. The cash flow mechanics run with absolute precision. Real estate gives you a steady defensive floor, corporate credit gives you inflation protection, and the options engine gives you the ultimate high-yield speed booster. The blended expense fee sits under 45 basis points, ensuring you keep over 99% of your compounding power inside your account. To keep this cash fortress safe over the long haul, you just need to follow a simple rebalancing rule twice a year. Because options funds ride on high volatility, their asset values can swing up and down. Every 6 months, look at your portfolio weights. When a tech rally causes your options engine to distribute huge cash windfalls, you take those surplus profits and instantly rotate them into your steady real estate and corporate credit pillars. This permanently locks in a higher baseline of recurring cash by buying more physical property shares. On the flip side, if the market goes sideways, you use your unwavering real estate checks to buy discounted shares of your options engine at cyclical lows. Review the institutional risk disclosure on screen and in the description box before executing any capital moves. If you are ready to break free from standard index models and build a compressed cash machine, hit that subscribe button right now. Stay disciplined, protect your capital baseline, and always track the data.